Hello everyone. It is an important video for you all where you can judge yourself in the upcoming proceedings, in your working, in the upcoming days in the market, where you can analyze technically and fundamentally what trade I am thinking, what trade to do, what next, what else to do. Either I sell or I buy. Whatever I did, whatever I do in the upcoming days, two important terms I have to keep in mind, and you all should keep in mind, that is the inflation and the interest rates. Before taking any trade, either you buy any stock or you buy a put option or a call option, whatever you take, set in your mind the two terms, inflation and the interest rate. A brief explanation about these two terms in this video I am going to share with you all, and few charts, open interest rates, open interest, then FII DI data, technical charts, important inflation chart I am going to show you in this video. So guys, it's a very important thing for this 2022. It's a general tendency for interest rates and the rate of inflation to have an inverse relationship. When interest rates are low, the economy grows and inflation increases. When interest rates are high, the economy slows and inflation decreases. In general, as interest rates are reduced, more people are able to borrow more money. What happens? Consumers have more money to spend. This causes the economy to grow and inflation to increase. A term is, in economic term, it's hyperinflation. It is used to describe extreme inflation. In an environment when there is hyperinflation, price increases are rapid and uncontrolled. Annual inflation rate for central banks are 2 to 3% per annum. Hyperinflation goes well beyond this. What about savings, loans? The interest rate determines the price of holding or loaning money. Banks pay an interest rate on savings in order to attract depositors. Banks also receive an interest rate for money that is loaned from their deposits. When interest rates are low, individuals and business tend to demand more loans. What happens? It increases the money supply in a fractional reserve banking system. Thus, low interest rates tend to result in more inflation. High interest rates tend to lower inflation. It highlights why interest rates and inflations tend to be inversely correlated. Inflation is often used to describe the impact of rising oil or food prices on the economy. For example, if the price of oil goes from rupees 75 to rupees 100, then input prices for businesses will increase and transportation cost for everyone will also increase. This may cause many other prices to rise in response. So, inflation is viewed as a positive when it helps boost consumer demand and consumption, driving economic growth. Many economists believe inflation comes out when the supply of money is greater than the demand for money. Some believe inflation is meant to keep deflation in check, while others think inflation is a drag on the economy. When the economy is not running at capacity, meaning there is unused labor or resources, inflation theoretically helps increase production. More money translates to more spending. which equates to more aggregated demand. More demand in turn triggers more production to meet the demand, isn't it? What about India? Inflation is generally defined as the increase of prices of goods and services over a certain period of time, as opposed to deflation, which describes a decrease of these prices. Inflation is a significant economic indicator for a country. The inflation rate is the rate at which the general rise in the level of prices, goods and services in an economy occurs and how it affects the cost of living of those living in a particular country. It influences the interest rates paid on savings and mortgages rates, but also have a bearing on levels of state pensions and benefits received. India's inflation rate has been on the rise over the last decade. However, it has been decreasing slightly since 2010. India's economy, however, has been doing quite well, with its GDP increasing steadily for years and its national debt decreasing. The budget balance in relation to GDP is not looking too good, with the state deficit amounting to more than 9% of GDP. So, guys, a very, very important thing is that inflation is the highest level inflation will create a crisis, will create a demand. So, guys, in this nifty chart, when we are looking forward, then we are seeing that I have marked what 22nd of November and 29th of November zone. We are bullish after 22nd of November's high breaked, we are bullish. But I don't think it will happen because inflation is on rise. It will come to 29th of November 2021 zone. If this level breaks, we are going for a next bottom. When it will cross 16410, it will break that level and it will come down below 200 EMA, the blue line, this line. Okay, so guys, see this very carefully and trade in a very careful manner. You have listened one thing, that Fed will increase the interest rate 3 times. So it will affect in Bank Nifty, and Bank Nifty has a great contribution in Nifty. So if Fed will increase the rate, Bank Nifty will be down. So as soon as Bank Nifty will be down, Nifty will also go down. 200 EMA level one time Bank Nifty crossed below. This time if it crossed, then we are going for 32,000 level. So guys, we are in such a situation where market can get crashed. So guys, one thing I want to tell you, before taking any trade, keep in mind that inflation and the interest rates are the two factors, major key factors of the upcoming days of trading. Thanks to Investopedia for this inflation and interest rate concept, and I hope you get benefited from this video. And if you get benefited, please join this link and subscribe to our channel. We are new to you, and I hope you will get a better video from this after this, and it will help you in trading. Thank you.